Good morning to all of you. Is I audible?
Yes, sir.
Okay. Thank you. So this is the session of the financial reporting. In the last sessions, from last two sessions, we understand uh, how the financial reporting should be of the any organization. Like the weekly financial reporting is very essential for the different we can say the stakeholders to take the different decisions. In the last sessions, what we learned we can say the different financial statements. That is the balance sheet, income statements, cash flow statements, we can say the changes in the equity statements. So all these statements who shows the financial positions of the organizations. So the effective financial reporting is, we can say, has the positive effect on the decisions of the different stakeholders. We also see how the, we can say, the fake or the bias financial reporting hampers the financial position of the organizations. Okay, so that may hamper the different financial decisions which are taken by the different stakeholders. Okay, as we know, the different stakeholders include, we can say, the investors, creditors, management, regulatory bodies, governments, customers of the organizations. So all these are the stakeholders. Okay, who uses the financial statements to take the different financial decisions. So in financial reporting, we learn that we can say the realistic data and the accuracy should be there. Okay, what numbers actually seen in the organization that actually put in the financial reports, and then only we can say the decisions making for the different stakeholder is effective. So now we are going in this sessions. In the first chapter, we will learn all these things. So from the chapter second, now we are studying the chapter second. So in chapter second, we will learn that is the division 2 of the schedule third of the Indian Companies Act Amendment 2015. As you all guys are aware, that is the Companies Act 2013. We can say bring by the government to govern the companies in India. Okay, but after when the we can say the NDA government or the Modi government formed in the center in 2014, they made some changes and the amendments in the Companies Act 2013. Okay, so they came up with the amendment bill, that is the companies Indian Companies Amendment Act 2015. Okay, so in that act, they tells the, we can say, the organizations, okay, about how to prepare the balance sheet and the statements in the changes in equity. Okay, what are the we can say the, we can say, the essential part. Okay, what they need to put in the financial statements, how to share the financial reports. Okay, all these things which the government include in this act, that is company Indian Companies Amendment Act 2015, which is the amendment of the Indian Companies Act 2013. Okay, so within the 2 years, government provide some guidelines to the organizations to prepare the balance sheets and the statement of changes in equity. Now, I think what I thought you already knows, these is two financial statements, that is the balance sheet and the statements in the changes in equity. I already told you in the previous sessions, and you guys also learn these two. We can say the financial statements in your subject, that is the managerial accounting. Okay, so balance sheet is the financial statement which shows the financial position of the organizations. Now, what is mean by the financial position of the organizations? Okay, it may be a good, it may be a bad. Okay, so how we conclude that the financial position of the organization is good and the financial position of the organization is not good. Okay, it depends upon, we can say, the assets, okay, and the liabilities the companies have. Okay, so assets is the part, on that basis the companies can earn the revenue. They can generate the income, they can generate the profit. Okay, so we can say, and the liabilities are the financial obligations which are not, we can say, giving the profit, revenue, or the income to the organizations. It is, we can say, it is the financial obligations to the organization. So they has to pay the certain amount of money to the other parties. That is the liabilities. Okay. So in balance sheet, what the government provides some guidelines how to put these assets and liabilities in a balance sheet. Okay. These are we are going to discuss in this chapter second. Okay. Also, the statement in the changes in equity. As we all know, that is the owners of the organizations are the shareholders of the organizations who are the real owners of the organizations has put some amount of money in the business. Okay, but the it is not a thing that there we can say equity or the shares is same throughout the years. Okay, now it is continuously changing. If the owners or the shareholders of the organizations increases their investment, or we can say whenever the organizations we can say generates the revenue, generates the profit. Okay, so out of that profit they reinvest the amount. Okay, and due to this, the we can say the equity of the owners and the shareholders gets increases. Okay, so how this happened, or it may be a case in certain cases, if the organization's business is not going well, okay, they faces losses. In that case, maybe the equity of the owners and the shareholders may gets decreases, because as we know, that is the shareholders are the real owners of the organization. So if they gets the profit as well, and they has to bear the losses as well. If the company is doing the well, they taste the profit. Okay, if the company is making the losses, the owners of the organization has to bear the losses. So in some of the cases, when the company is not doing well, the business of the company is facing the losses, then in some cases the equity of the shareholders may get decreases. So how these, we can say, these two statements, that is the balance sheet and the changes in the equity. So government provides certain guidelines. Okay, so we are going to see this in this chapter, in these sessions. Okay, so first we can say we see the what is the Schedule Third and the Division Two of the Companies Act 2015. Okay, so the Schedule 3 prescribe the format and disclosure required for the financial statements under the Companies Act 2013. Okay, so already these we can say the formats and the disclosures they're present in the Companies Act 2013, but the government provide some standardized framework. Okay, so the government provides the standardized framework that ensures the consistency and the comparability across the companies. Okay, the what government founds, we can say before coming with this amendment act, the companies do not follow, we can say the same, we can say the format for to prepare the different financial statements. So and so that to compare the different type of organizations, okay, or the same organization for over a period of time, and we can say, and to ensure the, we can say, the consistency in the reporting, the government came with this, that is the Amendment Act 2015, Companies Amendment Act 2015. Also, the Division 2 specifically applies to the companies preparing the financial statements under the Indian accounting standards. So it is, we can say it's applicable to all the companies which works under the Indian regime, Indian geographical area, who prepare their financial statements according to the Indian accounting standards. Okay, so they creating alignment with the international standards while addressing the unique to Indian requirements. So what government thought that the alignment of the Indian requirement is with the international standard. Okay, because we know that the Indian companies compete with the foreign companies. So whenever we compare the financial position of the Indian organizations with the foreign organizations, so when we are able to compare, when there is the, we can see the uniformity in the financial reporting. Okay, so that's why the government came with this Schedule Third and the Division Two, that is the Companies Amendment Act 2015. The 2015 amendment introduces significant changes to enhance the transparency. Okay, so government was they want transparency in the financial reporting and align with the global standard, reflecting India's commitment to the world-class financial reporting. Okay, because as we know that India is developing at a very fast pace. Some of the companies, we can say this the startups or the entrepreneurs in the Indian market are we can say doing very well. Some of the companies like the Tata, Reliance, TCS, Infosys, Cognizant. So all these organizations is we can say these having the international clients. Okay, and they compete at on the international level, so they must be follow the international standards, global standards, to compare their financials with the other organizations. So that's why the government come with this, that is the amendment act. Now what is meant by the amendment act? First I want to tell you the amendment is nothing but the changes in the existing law. Okay, so we already have the Indian Companies Act 2013, but whenever the government wants to change certain change in any act, the government has the power of amendment in the existing law. Okay, so government can come up with the amendment and pass the bill in both the houses of the parliament, that is in Lok Sabha and in Rajya Sabha, and when the president signs the law. Okay, so law we can say came into the force. So this is the procedure of the amendment of the any act. Okay, so it is not the case in the we can say the Constitution of India. Whenever the any law made by the government or the we can say the both the houses of the parliament, okay, so it may remain same all over time. Okay, whenever a government wants there is a certain changes needed, they can come up with the amendment. So likewise the government came with the amendments in the Companies Act because they want the financial reporting with the certain global standard. Okay, they want the uniform financial reporting, or they want the consistency, and that's why the government come with this law. That is why the division 2 matters, aligning the Indian companies with the global standard. Okay, so why this amendment needed? Okay, so why government came with this amendment? Okay, what government thoughts? That is why because of the alignment of the Indian companies with the global standard. Okay, so in what sense the Indian companies we can say have to we can say follow the global standard, that is the global comparability. Okay, so Indian AS compliance ensures the we can say the comparability with the IFRS based reporting worldwide, positioning Indian companies on the global stage. Okay, so to compare the Indian companies with the foreign companies, okay, we can say these features must be included in the financial reporting of the Indian organizations. We can say the enhance the transparency. The government wants the transparency in the financial reporting of the organizations. As we know, before the 2014, the many of the frauds in the organization, the many of the frauds like the 2G scams, okay, the coal scams, Raw Modi scams. So all these scams were happening around the time. So the government thinks that so there is a need of amendment in the financial reporting of the organizations to ensure we can say the financial transparency. Okay, so the Division 2 mandates the detailed disclosure, improving investors' confidence and the corporate governance through comprehensive reporting and the realistic reporting. Okay, now next one is we can see the regulatory balance. The government wants the complete overview on the financial position of the different organizations. As we know, the any of the big multinational company corporations, we can say stuck in the financial frauds that hampered the employment of the many people. Okay, that may hamper the economy of India. So that's why government wants the regulatory balance or the complete control. So that's why the government addressed the unique regulatory requirement alongside the Indian accounting standards principle, creating the framework that respect both global standard. That means we that means our government at the time of the amendment, thinks of both the things, that is the global standards and the Indian requirements. And according to that, they came it with this amendment, that is the Indian Companies Amendment Act 2015. Okay, so overview of the balance sheets under the Division 2. As we all know, what there is in the balance sheets. Okay, we see that is the first if you see the vertical balance sheet, vertical position of the balance sheet, then we know the assets is on the upper side and the liabilities is on the lower sides. Equities and liabilities is on the other side, okay, or the lower sides. So in assets, mm, first we see we can see the structure of the balance sheets, and then we will see the previous part. So it is the structure of the balance sheet. Okay, so balance sheets under Division 2 must follow the specific vertical format that clearly segregates the assets, equity, and the liabilities. And this format enhances the comparability across the Indian, we can say the compliant companies. Guys, due to we can say due to the lack of space, I put this on the other side. Okay, the side by side, that is the assets and equities and liabilities. But actually, what the Amendment Act 2015 tells us that the specific vertical format. Okay, so assets is on upper sides and the equities and liabilities on the lower sides. So in assets, there are the assets is of the two types. That is the non-current assets and the current assets. So the first we understand what is the non-current assets. So non-current assets are those assets which we cannot convert easily into the cash, easily into the money. Okay, we require if we want to convert that assets into money or into a cash, we require the time period of more than 1 year, and that all the assets we called it as a non-current assets. And the current assets are such a type of assets who are easily convertible into a cash. We can convert these assets within a 1 year into a cash within a 365 days. So as we know, the inventories, that is the financial investments such as the trade receivables, cash equivalents, other bank, if we have the cash in the banks, the bank balances, we can see the tax assets and the other current assets. So all these we can easily convert into a cash, and whenever the organizations require the cash for their working capital, they use their current assets to fulfill the requirement of a working capital. So the non-current assets are the assets which will not easily convertible into cash. Okay, so we can say the property, plant, equipments. So this requires the times to sell. Okay, this requires the time to get the payments. Okay, so the capital work in progress. Okay, we know the if we are producing any product, the work in progress, but that requires the time to sales into the market and get the payment, because we can say the product is in a process, then it will be finished goods, it will be sent into the market, then it'll get sales, and then we will receive the payment. So it is the time consuming process. Then the investment, the property, goodwill, other tangible assets, the tangible assets under development, uh, biological assets, other than the barrier plant, the financial assets, we can say so these are the all the non-current assets. Same likewise, on the liability sides, we put that is the equities and the liabilities. Okay, so equity in equity, we can say the equity share capital, other share capital, that is the preference share capitals. Okay, so all these we can say comes under the liabilities. Okay, now next part is the non-current liabilities. So non-current liabilities are such liabilities which we have to we can say pay after the 1 year. Okay, sir. So the financial liabilities, for example, the borrowings, that is the trade payables. We can say some of the, we can see if we take the long-term loans. Okay, so all these are the non-current liabilities. Okay, so current liabilities are those liabilities which we have to pay within a year, within a 365 days. Okay, so we can say the creditors, the other provisions, borrowing, trade payables, all these are the non-current liabilities. Okay, so this is the format we can say uh, tells by the Amendment Act 2015. Okay, so first we understand the now we understand what is the balance sheets and what are the contents of the balance sheets. Okay, we now know the we can say on upper side we put the assets and the lower sides we put the liabilities. Okay, so if the assets are more than the liabilities, then automatically the company is having, that means the company is, we can say, generating the more income, more revenue. That means the financial position of the organization is good. If the liability of the organizations are more, that means the company is in the we can say the financial stagnation. So at that time, the company is not in the good financial position. Okay, so we'll see what the instructions are given under the division 2 to prepare the balance sheets. Okay, so balance sheet presents the financial position at the reporting date. Okay, so offering a snapshot of its assets, liabilities, and equities, as we see just now how it's shown, that is the assets, liabilities, and equity under the financial, that is the balance sheets. Now, this critical documents follows the specific formatting and disclosure requirements. So these are the three specifications given under the Amendment 2015, that is the detail line items. That is the division to specify the detail line items and the sub-classification for assets, liabilities, and equity. Okay, we sub-classify, we can say the different headings. That is, we classify the assets into the current assets and non-current assets. We classify the liabilities into the current liabilities and non-current liabilities and equity. So requiring the more granular reporting and the previous standard. Okay. So when we classify this, we can see the main headings. Okay. So we will also have we can say the some of the others require data also. Okay, so we can from the balance sheets I can tell you what the current assets I have. That means within a 365 days how much cash I can raise, how much money I can raise uh, by converting my assets into the liquidity, that is into the money. Okay, so after the 1 year, how much money I can raise, that tells me by the non-current assets. The same likewise within a year, how much financial obligations I have, how much amount I have to pay to my creditors, okay, to the provisions for the payment. So all these things we can tell on the basis of the different sub-classifications. Okay, so the comparative figures. Require the comparative figures for the current and the previous reporting period, enable the stakeholders to analyze the trends and changes over the time. As you guys in the last semester in financial management, you learn, we can say, the tools and techniques to analyze the financial statements. Okay, in that part, you learn the comparative financial statement. Okay, so in comparative financial statement, what we do, we compare the data for the 2 years. Okay, so we compare the data. That means we check the current assets increases or not. Okay, current liabilities increases or decreases. Same likewise, non-current assets increases or decreases. Okay, equities increases or decreases. So all these things we can analyze by comparing the data for the same organizations for over a period of time. Okay, now next one is that is the structure format. So the prescribed and the standardized format that ensures the consistency across the companies. If all the organizations follows the same norms, rules, regulations which is given by the government, then what happened? We can say there is the uniformity in the financial reporting. So we can say the understandability is we can say is easy to all the stakeholder who we can say see the financial statement of the different organizations, he can easily understand because it is uniform all over the Indian for the Indian companies, so he can easily understand. So the making financial statement more accessible to investors and the regulators. Okay, because the financial information is very essential to take the different decisions. So that's why we can see the financial statements are what government wants. Government wants a easy accessibility to the financial informations because on that basis the different stakeholders take the decisions. Okay. So what are the we can say the general instructions given by the government in the Indian we can say the Companies Amendment Act 2015, that is the uniform rounding. What government want? Government wants the uniform rounding. The figure must be rounded off uniformity depending upon the company's turnover. That is means the whatever adjustments are the we can say different organizations are doing in the financial statements, that is the balance sheet should be a uniform. Okay, then and then only that there is a uniformity in the financial statements. The comprehensive notes. The notes to account must provide the narrative descriptions and the cross reference for all the items, offering the context and explanation for the numbers presented. Okay, so government wants the comprehensive notes. Okay, so how the fund flows, okay, to whom we are giving the payment, from where we receive the payment, okay, where we spend the expenses, from where we generate the incomes. So all these notes, if they are comprehensively present in the financial statements, then the readers understands the financial informations very easily, uh, and he can take then the effective decisions. Now, some of the additional disclosures the government wants from the organizations in the financial reporting. So, what are these additional disclosures? The additional disclosure required by the Indian accounting standards or the Companies Act must be included in notes. Okay, okay. So those are required. So these the companies have to put in the comprehensive notes. But if the companies think so, if some of the notes are not mandated by the government, but it is the requirement of the financial, we can say the information or this. Without that, we can say the information. We can say the stakeholders or the readers who read the financial statements are not able to understand the financial information, then that information must be, we can say, mentioned in the, we can say, the balance sheet. So the all the readers can easily understand the information. Okay, so that part, that is the balance sheets formats, we already learned. I already told you, and you guys already learn the balance sheets in your both the subjects, that is in also in financial management also. You analyze this financial statement. That means you analyze the balance sheet by using the different tools and techniques. Okay, you analyze the balance sheets by using the comparative financial statements and also by using the formulas in the ratio analysis. Okay, you calculate the liquidity position of the organizations by calculating the liquidity ratio, current ratio. Okay, you calculate the we can say the different turnover ratio. Okay, you calculate the solvency ratio. So that means you calculate the repayment ability of the organizations. Okay, so this analysis part you already learned in the final semester financial management subject. So you all aware about the we can say the generalized format of the balance sheet. But I already to your understandability, here the format of the balance sheet. Okay. So what is the, we can say, the equities and liabilities, that is the shareholders fund. So what the Companies Act 2015 tells regarding this, how the equities and liabilities should mentions in the balance sheets. Okay, so for share capital, that is the equities, for what government tells, that is the authorized, issued, and this subscribe, and the paid up capital detail must be separately disclosed along with the reconciliation of the shares outstanding. Okay, so government wants the detailed information regarding the authorized, issued, and the subscribe, we can say, and the paid up capital. So what are these terms? Okay, so authorized capital is the capital, we can say, the stock exchange authorized to the company to raise that much amount. That means if we can say the Reliance is the one company, the Reliance wants to raise the funds through share capital. So what then Reliance can do? The Reliance, we can say, have the communication with the stock exchange. Okay, so then stock exchange check all their financial information, so their products, services, and all these things, and they authorize the Reliance to raise some amount of money. If you, for example, if you say the 100 crores authorized by the stock exchange to Reliance, so they can raise the funds up to the 100 crores, not above that. Okay, so 100 is the limit that is authorized by the stock exchange. That is the authorized capital. That means the Reliance can maximum raise the fund through share capital is the 100 crore. Okay, but when the Reliance gets the authorized capital of the 100 crores, but if they do not require the 100 crore at that time, okay, so what they do, they issued the share of the 70 crores in the market. Okay, only the 70 crores. They have the authority to issue the 100 crores, but they now issue only the 70 crores. So out of that 70 crores, we can say only the, we can say, the if the 50 crore shares were sold into the market, that is the subscribe capital. Okay, and out of that 50, we can say, crores, they only receive the 40 crores. Okay, so 10 crore is pending. So that 40 crore is the paid up capital. So this is, we can say, this is the authorized, issued, subscribed, and the paid up capital amount. So that detail must be separately disclosed. The government wants this separate, we can say, mention of each and every shares into the, we can say, balance sheet. Regarding the reserve and surplus, what government advised, uh, or we can say what the Companies Act 2015 advised, that must be broken down by the, we can say, example, the capital reserve, securities premium, retained earning, with each category, purpose, and the moment explained. Okay. So, so, so these are the types, different types, or the, we can say, the reserve and the surplus. That is the retained earning. So whenever the government, not a government, but whenever the organizations, we can say, generating the income, that means they are having the, we can say, the earnings. Okay, so they not distribute among these earnings into the shareholder, the organization will retain that earning for the further expansion. So in that case, we can say the government bonds, that is the capital reserve, that is the securities premium, and the retained earning notes separately into the balance sheet. Bonus share, they can issue dividends, the extra shares. Whenever there is the fund, the government wants to mention the same thing separately into the balance sheet. Now, next one is what equity, liability, non-current assets, and we can say current liabilities. Now we understand what is meant by the uh, current liabilities and non-current liabilities. So I already told you that due within the 12 months. That means you have to pay this amount of money, okay, within the 365 days. That is the 12 month. That is the current liabilities. So non-current liabilities are those liabilities which you have to pay after the 1 year, after the 365 days. Okay. These are the non-current liabilities. So government, or we can say the Act, the Amendment Act 2015 wants the separate, we can say, entry of the current liabilities and the non-current liability. There's some of the we can say the examples here given. So we need to identify which is the current liability and which one is the non-current liability. So borrowing is a long term and the short term borrowing. If the borrowing is the long term, so then that is the non-current liability. If the borrowing is the short term, then it is the current liabilities. Okay. What government want, the we can say must these entries should be classified separately. Okay. We can say the short-term borrowing and the long-term borrowing both are the borrowings, but the time period or the time horizon is different for both the borrowings. Okay, so on that basis, we classify it into the current liabilities and non-current liabilities. So the government want the we can say the non-current liabilities goes into the non-current table, and the current liabilities, that is the short-term borrowings, into the current liability. Same likewise, we can see the trade payables. They must disclose the amount dues of the micro, small, and the medium enterprises. Okay, so if the trade payables, we can say, which we need to do within the year, then it is the current liabilities, and after the 1 year is the non-current liabilities. Okay, so likewise, we can divide the different, we can say, the liabilities into the two parts, and the separate, we can say, the separate. In the different we can say types, okay, under which they have to mention, that's the requirement of the Companies Act 2015. Okay, so same likewise, the classification of the liabilities, the classification of the assets should be there, that is the non-current assets and the current assets. Okay, so those assets that we convert into the cash within the 1 year, then 65 days, that we call as the current assets. And those which we cannot easily convert into the cash, and that is after the 1 year we can convert it into the cash, that is the non-current assets. So here some of the examples are given, that is the property, plant and equipment. So these are the non-current liabilities. So because we cannot easily convert it into the cash. Okay, also the goodwill, patent, software. So okay, so all these are the non-current assets. After the some point of time, we can convert it into the we can say the money. Okay, all the here the examples are given of the non-current assets. That is the investment, loans, long-term receivable, disclosures. Okay, so all these are the examples of the non-current assets. Okay, so here are the now we will see what is the current assets. Okay, so the current assets are the assets we can be easily converted into the cash within the 365 days, within a year, that we called as the current assets. Here are some of the examples are given. That is the inventories, that is the raw materials, work in progress. You can say the finished goods are the current assets. The trade receivables which we receive within a year, the credit input, cash and cash equivalent, cash, bank balances, short-term deposits, loan advances, all these are the current assets. So that will be all sees regarding the balance sheet. What government wants a uniform format. Okay, on the upper side, what they want, we can say assets. Okay, and they want the classification of assets into the two parts, that is the current assets and non-current assets. In the we can say in the lower sides, what the provision wants, they wants the equities and liabilities. um, so they want the clear separation of the equities also. They want the authorized, we can say authorized, issued, and the paid up capital. Okay, so all they want is in the separate entry. Okay, so these are the we can say some of the detail instructions given in the, we can say, the Companies Amendment Act Division 2 Part 3 regarding the balance sheets. Okay, now we will see the, we can say, the statements of the changes in the equity and the purpose and importance. So why this, we can say, his statement is important from the point of view of the business. As we know, the owners or the shareholders who are the, we can say, the real owners of the organizations. Okay, they put their amount of money in the organizations in the hope of the, you can say, the return, or they want to maximize their wealth. Okay, and that's why the every businessman is doing a business. Okay, so what is the main motive of the business? To generate the revenue, to generate the profit. It is the main motive of any organization. Okay. um, by, we can say, uh, repairing this statement, okay, we will see the wealth of the shareholders or the owners of the organization is increase or decrease. Okay, so that we know by this statement, okay, or by this financial informations. Okay, so why this statement is important? So here some of the points are given, that is the comprehensive moment record. Okay, so these, we can say, the changes in equity, that information shows the reflects the movement in equity components during the reporting period, including the share capital changes, reserve, retained earnings, and the other comprehensive incomes. Okay, we analyze all these things. Okay, we know if we take the any certain time period, if we take the 2015 to 2025, in this period, the share capital, what is the trends? Okay, so how the equity gets changes? Okay, if we see, if we analyze the equity of the organizations, if we see the due to of the COVID-19 period, the equity may gets decreases in the 2 3 years period, and then there is a upward movement of the equity. So these are the trends that we analyze by, we can say, by this statement, that is the changes in the equity, that is the ownership transparency. Okay, in some of the cases, if in some of the companies, as we know, is the a huge financial institution, or the, we can say, the individual who wants to overtake the any organization, what he do, he continuously buy the shares of that particular company. Okay, and his equity over a period of time gets decreases. What the Elon Musk did the same thing with the Twitter. Okay, he wants to buy the Twitter for a longer period of time. So what he starts to buying the shares of the Twitters in the share market. Okay, so that the ownership, we can say, the transfer, we are going to analyze by analyzing these changes in the equity. It may happen in some cases that yes, the real owners may lose the ownership because of the other individuals continuously buying the shares of the any particular company. Okay, so that's why the analysis of the changes in equity is more important. Okay, on that, in that statement, we know who is the major owner of the organization, who is the decision maker. As we know, the who is the individual or the person who is having near about the 51%, 51% or more than 51% shares in the only organization. He is the major owner of the organization. Okay, so he we has the influence on the different decisions of the organization or the company. Okay, so uh, in the, we can say, changes in the equity statement tells us the who is the major owner, or there is a, if the transfer of the ownership is going on, so who will be the next one? So that part we analyze in the changes in the equity. That is, next one is the next important, we can say, the purpose is the regulatory compliance. They required by the Division 2 to comply with the Indian Standard 1 to ensure the Indian companies meet the international reporting standard. Okay, so the different regulatory bodies are the government. They want the information that who is the, we can see, the owner of the organizations, what is the position of the equity in that organization or the company. So, and because of this, that is, so this is the purpose and the importance of the equity changes in the equity statement. Okay. So, we can say what we include. So, what are the different parameters of the, we can say, the changes in the equity statement. Okay, unlike the, we can see, the previous accounting framework, the Indian accounting standards mandate the separate statement of changes in equity. Okay, on the government mandate, mandatory to all the organizations or the companies to disclose the changes in the equity statement for the information of the different stakeholders. Okay, so this statement provides the transparency regarding the movement in the shareholders' funds during the reporting period. Okay, so what these statements tells us, I already told you, the movement in the changes in the equity. Okay, where this ownership goes, who is the major owner? If is the equity is, we can say, increases or decreases. So all these trends tells by this, we can say, the statements of changes in equity. So what it includes? It includes the equity share capital. Okay, so the detailed reconciliations are showing the opening balance changes during the period, how much they issue, how much shares they issue in that particular period, okay, how much buybacks, okay, how much shares buyback by the company from their share holders, okay, or the other adjustment and the closing balance of the equity share capital. So all these things must be included in your, we can say, the statement of changes in equity. So you guys, I think you guys are aware about the issue of the shares, but you guys are not aware about the buybacks of the shares. Okay, guys. So I'll tell you what is the buyback. So buyback is the concept when we can say the company thinks that they loses the ownership in the organization or in the company. Okay, they think that they may lose their ownership in the future. Okay, so if they lost the ownership, they lost the position of the decision maker in the organization or in the company. So they start buying their own shares from their shareholders. So that who is, we can say, the major owner of the organization has the major ownership. He may not lost the ownership above 55%. He always have the shares in the organizations above 51%, maybe 60%, 70%. So buyback is the, we can say, the rebuying the sale, we can say, shares from the shareholders. That is the buybacks. Okay, the other equity components, that statement must include the other equity components like the, we can say, we can say the reserve and the surplus, which we can say they clearly mention, and their breakdowns, their classification must mention in the statements, including the securities premium, general reserve, retained earnings, and the other components. Okay, that must be included in the, we can say, the statements in the equity. Okay, so the other comprehensive incomes, also government, the Companies Act 2015 wants to mention in the changes in the equity statements. This separate disclosure of items that will not be reclassified to profit or loss. That is the revaluation, surplus, the remeasurements of the defined benefit plans, and the items that may be declassified subsequently. So these other comprehensive income, that is the part of the, we can say, the incomes, and it will be also the part of the surplus. The Companies Act wants to mention separately. So we can see the detailed disclosure requirement of these statements of changes in the equity. So, okay, so what the disclosure requirement? Okay, so what should be there in the statement of changes in equity? First thing is the reserve description. Okay, so description of each reserve purpose and movement reasons, the providing the context of the stakeholder. So reserve is nothing but it. It is the part of the income of the organization or income of the company. Okay, so whenever the company generates the income, generates the profit is belongs to the shareholders. Okay, but if the board members of the organization, the board of director uh, decides that they do not, we can say, given out the dividends to their shareholders, then that party is called it as the reserve. They keep that amount of profit or the income as a reserve for the further expansion of their business. So this reserve is nothing but it is the we can say it is the uh, we can say the part of the shares of the shareholder. It is the shareholder fund itself. Okay, if the company pay out the dividend, then the shareholder gets that fund. Okay, but if they not get that fund, so it is their own funds only. Okay, so these reserves description should be in detail what the companies Act 2015 want. The balance reconciliation, the reconciliation of the opening and the closing balances of each equity components, that is for the each equity, that is we can say we find the different equities, that is we can say the issued buybacks and the all these things, that is the equity shares, preference shares, their opening balances and the closing balances must be there. That is these all the reconciliation should be clearly mentioned in the changes in the equity statement. Now, there is the owner transactions. The impact of transactions with the owner, that is the dividend buybacks, are disclosed separately from the performance related changes. Okay. So I told you what is dividend, what is the buyback. So all these things should be clearly mentioned in the changes in the equity statements, and at the end of the statements, we find it out how much change uh, there in the equity. If it is a positive or a negative, okay, in the each separate entity, we can say find out the change, how much change they happen. Okay, so now the next part is we can see the trade payables, receivable, and the enhanced disclosure. So uh, that part we will see in the next sessions. Okay, so the time is up. So if you have any question, you can ask, or we will sum up the sessions over here. Okay? Next part we will see in the next session. Okay. Anyone have any question regarding this, or we will end the session? No one have no question? Okay, then we end the session. You can give now.